Well, good morning, everyone. I think we're ready to get started. Thanks, everybody, for joining, and welcome to today's discussion on the top 10 trends that we in the market structure and technology team here at Greenwich see for 2021. And to be fair, we actually have 11 trends this year, but I guess that breaking convention is probably appropriate in this time. So I'm Dan Connell, Managing Director and Head of the Market Structure and Technology Practice here at Greenwich, and I'll be hosting today. Let me cover a few housekeeping items before we get started. First one is if you've got an echo going on, just make sure you have telephone selected. That should take care of it, so you're not doubling up on the audio. Throughout the presentations, if you have questions, please type them in. We will try to get to them. I know we have a lot of topics to get to, but we welcome your input and we will get to them as time allows. And if you have additional questions after the webinar, please, that's the intent. Our contact information will be provided, and either type them in, we'll reach back out to you, or contact us directly. And then lastly, we will have a quick survey at the end. We want to hear your opinion, and we want to know what topics you want us to cover as we continue these series. So before we begin, for anyone that isn't familiar with the market structure and technology practice in particular, we focus all our attention on the way technology, regulation, macroeconomic, even political changes occur and how they impact the market participants. We say our differentiator is in the data that we amass in the process of our research, and we think that gives us confidence and gives our clients confidence with the insights and analysis that they can rely on from us. As we like to say, without the data, it's just another opinion. So with that, let me introduce the format for today. So we're going to be having basically an open discussion with the panel here, and I'm really happy to be joined by a number of our analysts from the market structure team. And let me tell you who they are. So we've got Kevin McPartland, who is our head of research. We're joined by Shane Swanson, senior analyst, focusing mostly in equities and technology. David Easthope, senior analyst as well, focusing on fintech, market data and analytics. Danielle Tierney, senior analyst, focusing on reg tech and risk. Brad Tingley, who is an analyst who handles just about everything we do, as well as a specific focus mostly in wealth, and then some on the market data and analytics side as well. So with that, what I'd like to do is I'll introduce each one of our projections for 2021 and then ask the right analyst to give their thoughts and views, and hopefully have a discussion around that, and then we'll try to move to the next. So the first one we have on the list is that market regulatory reform post-election and post-COVID going to be impacted, maybe, and we're going to hear what Kevin has to say about that.
Great, thanks, Dan. Thanks for kicking us off. Thanks, everybody, for joining. Yeah, all the signs for 2021 would point to more regulatory action this year than last year. We did just go through, obviously it was bigger than a market crisis, but we did go through a market crisis in 2020. Market crises definitely tend to end up with new regulation. And then we have Washington right now controlled by the Democrats, again, also, which tends to lead to more regulation rather than less, especially after the last 4 years, which sort of tend to step back a little bit from regulatory oversight in financial markets. The maybe in here, when you look really closely at the market crisis that we went through, obviously we did quite a bit of work on that, and so did probably every other market analyst out there. But really, we didn't feel like that was a failure of market structure. That was really just an economic event. And furthermore, the market really did sort of come back very quickly, right? This wasn't a long, drawn-out issue like a credit crisis was 12, 13 years ago, right? The market really did snap back. Of course, the Fed intervention had a lot to do with that. We can't deny that. But it is hard to argue that what happened created some long-lasting impact on market structure specifically. The economy, of course, is a different story, but on market structure, it's hard to see a negative impact, and one could argue that acceleration of technology adoption across markets, in fact, is actually a long-term positive impact. So, and then the news yesterday, right, is Gary Gensler might come in to run the SEC. He was prolific, to say the least, at the CFTC and implementing Dodd-Frank. Will we see something similar to the SEC? Time will tell, but certainly, market regulation will be something to watch in 2021.
Great, thanks, Kev. Next on the docket, we titled Exchanges, Trading Venues, and Data Providers Have an Identity Crisis. And there's certainly been some interesting changes in the exchange world. I'm going to ask Shane to talk about that.
Great, thanks, Dan. Again, I think this is an interesting view of the world we've taken here. So when you look at things from a practical perspective, non-practitioners, and probably a lot of practitioners, in fact, when you think of an exchange, you really think of the listing venues, right? It's synonymous with the New York Stock Exchange, with NASDAQ, and for us, CBOE and BATS. But we also tend to think of the exchanges as where the markets trade. Because I'm a market structure geek, I like to look at the SEC rules and definitions. And as the SEC puts it, it's what constitutes or maintains or provides a marketplace or facilities for bringing together purchasers and sellers of securities. That's the hardcore definition that you get out of Reg ATS and Reg NMS, and tie it all together. There's some qualifying language about you have to have certain non-discriminatory rules. All of that means is that's what an exchange actually is. But when you look at the exchange groups today, that's not all they do, right? If you actually go to the exchange parent companies, you look at NASDAQ, they really identify as a fintech company. So it's not just not just a market for buyers and sellers. They're really providing technology globally across any number of different silos. You look at the LSE combining with Refinitiv, and they're really looking more and more like a data provider. And then you look just the broader markets. You have ICE that owns NYSE. It's just this huge conglomerate. It's not simply, it's where the equities markets go to meet buyers and sellers anymore. So there's that whole evolution of what an exchange is, means, and actually does. You then you have this evolution in the fixed income markets, and we've seen these players have become more and more sophisticated. Again, not exactly exchanges, really the ECN ETF space, but those organizations just continue to grow, and they're rivaling the size of these other entities. You have Market Access with a market cap rivaling NASDAQ's. You have TradeWeb outsizing CBOE. The more and more they grow, right now they're getting most of their income from trade fees, but the market data that those organizations also command will become more and more important as we go forward. And when we talk about this identity crisis about data, there's enormous changes coming in the world of data. So we have Reg NMS 2.0 that the SEC has bequeathed to us going into 2021. And that regulatory part of the landscape, we see changes that are going to be coming in the SIPs. We see changes that are going to be coming potentially into the possibility of competing consolidators for that marketplace. So in terms of governance of the securities information processors, in terms of functionality, that regulatory update and rate of change has not slowed. If anything, it's accelerated on that side of the fence. So the entire market is really kind of undergoing this evolutionary change, and in the midst of that, we now have new administrations coming in who are now taking that on and have to come out and implement. And implementation is always where I think the devil in details comes forward. And with that, I'll stop.
So Shane, just a quick one on that. As you talk it through, given those changes, do you see more sort of big acquisitions coming in that exchange, with that exchange and data provider market overlap?
You see it happening constantly, right? There's evaluations, there's lots of dollars that I think are in their coffers, and certainly, CBOE's bought bids. It's smaller type acquisition, but it's a different type of acquisition in the U.S. equity space. An exchange actually owning a ATS. There aren't that many of those ATSs that can be bought that are not already part of larger consortiums. So these smaller entities, but I think all of those are potential targets. And certainly, I think larger combinations of data providers and exchanges and how those all interact and come together, we'll just see more of it because they have to be competitive. And once somebody owns a large part of the data market, you're going to see the pressure on others to compete in that space.
Yeah, well, and it opens up the web of who can buy who, right? We would always before think about a trading venue matching buyers and sellers, buying another trading venue matching buyers and sellers, maybe in a different asset class or in a different region. But now it can be anything, right? It can be data buying venue, venue buying data, fixed income buying equities, or vice versa. And in that regard,
infrastructure, right? Then you get into the infrastructure side of it with the whole cloud infrastructure, and we'll talk about that I know later, so I won't use up our powder there, but you can think of all of those different areas as being open targets.
Sure. Okay, let's run on. We next topic that we've been talking about for 18 months or so. Some of the delays have played into that from a regulatory perspective, but we titled this one, SOFR isn't enough to replace Libor, and competition heats up for an alternative. Kevin, you want to give that a go?
Yeah, I mean, we'd be crazy not to talk about Libor as a trend for 2021, but to your point, it's been talked about for ages. But when we thought about it harder and we thought about what it is that we really focus on here in the market structure team at Greenwich, we figured we'd leave the Libor transition and its mechanics to the lawyers and the consultants who are doing all the hard work. From our perspective, it was really interesting to think about the alternative and what that means from a product perspective, right? So the Libor SOFR transition, it's not a like for like, right? And I won't get into the mechanics today, but obviously we're talking the difference between term unsecured and overnight secured, right? So they're different rates. They're close, but they're not exactly the same. And close but not exactly the same doesn't work when you're talking about either hedging or funding, billions or if not trillions of dollars over time, right? So it's not something we can just sort of write off as a nuance. It's way more than a nuance. So what we think will be interesting, SOFR clearly is here to stay, right? It's been sort of backed by the Fed and such, but there are really interesting alternatives in the private sector. We have AFX, ICE and Bloomberg talking about, right, trying to the identity crisis, right? But ICE and Bloomberg are both sort of big in the space here as well and have their own ideas and alternatives. And there's also a huge amount of sort of revenue dollars control, if you will, tied to sort of the futures and swaps markets that sort of tie back to whichever rates the market ends up deciding are useful, right? So there's a huge ecosystem, being created now that is not just about the rate itself, but about all the products that use the rate and ways to manage the rate. That's not even to mention all the technology work that needs to go on to support and use all of those rates, right? Where for years it was just Libor as a default. So yeah, there's a huge product opportunity for the index and everything tied to the index that we think is in some ways only getting started despite all the years of work already.
So Kevin, a year ago we would have commented on, I guess, broadly market participant readiness for the swap over. Do you think that delay now has made everybody more comfortable with their readiness, or did everybody just delay and we're still at the same place we were a year ago?
Yeah, I mean, people are in better shape and have taken it more seriously. Although we have definitely heard that sort of reprieve for dollar Libor did leave some firms thinking, oh great, we have a few more years, we'll deal with that later. That's also probably not a good idea. This is not a big bang. You can't just switch over your contracts on the day that that Libor is officially unofficial. So yeah, the impetus is still there, and people shouldn't slow down in their transition efforts. And you can see that from the regulators and especially I think from the biggest banks and asset managers.
And Kevin, is there also an issue, I guess, with the Libor had such a history and it had such a well-greased mechanics and a huge amount of liquidity, as we look at not only switching, so SOFR or other alternatives, you don't have that same level of sophistication, you don't have the same level of liquidity. Isn't there something of a chicken and egg problem here of like, well, we don't want to transition until there's something to transition to, and yet nobody's we don't have to transition, so we're not going to make the transition, so the liquidity doesn't exist. How big a problem is that?
Yeah, well, you're right. If we, and it's completely a likely outcome that we end up with 3, 4, 5 different rates per currency to replace Libor, right? Because of things like the term or whether it's secured or not, even just differences in methodology. And maybe that's good. Maybe that allows corporations and asset managers to better hedge their portfolios or do what they need to do. But you're right, from a product perspective, if you take all of the liquidity that was, say, in the Eurodollar futures contract and spread it across a couple of different futures contracts, then yeah, you have a much less, each of those individual markets is theoretically less liquid than the one larger market we had before. So that will be, yeah, very good point and very interesting to watch.
Cool. So next we've got, Shane mentioned cloud computing. We titled this one, Cloud Computing Keeps Growing as Banks Spend Money to Save Money. And I'm going to ask David to take a go.
Thanks, Dan. I think we were just talking about this being a really big subject, right? We've all seen the impact of cloud on our lives in the last several months. And now we're seeing the importance of cloud across all of our different market segments, across our asset classes. And it's not just purely for market data distribution. And in our research, in our surveys, what we're definitely noticing and expect to continue on into 2021 is this change in mindset. And that is that seeing cloud as a key element, and specifically cloud computing, for reducing cost, increasing agility, increasing the level of responsiveness across banks and other organizations. And we're seeing this as well across this trend of public cloud over private cloud. So some banks, some tier 1 banks, for instance, are moving away from a strictly private cloud approach, strictly private, to multi-cloud, seeing this as a more popular approach, or even going full public cloud. We all saw, Deutsche Bank's announcement with Google, for example. So the banks are all getting more cloud friendly. You're seeing that mindset really shift. We see market data in the cloud. And now what we're seeing is the rise of trading and risk infrastructure, and particularly the software applications and systems to support these functions moving to the cloud. And we see that across things such as connectivity. We see software moving into the cloud, SaaS-based models. We even see FPGAs in the cloud. So in talking to the banks, we're also seeing more of these risk calculations as well moving there. Not everything in the risk domain is cloud friendly at the moment, although we're seeing things move in that direction. So anything that sort of takes or requires intensive computation and calculations, particularly it bursts sort of intraday or end of day, is very cloud friendly. So you can run your risk calculations, you can run portfolio simulations, and you can manage those resources throughout the day. And there are some topics in the risk area that come to mind, such as FRTB, CCAR, value at risk. Some of the things that are limiting across the trading and risk infrastructure are the unification of data sets. So we're seeing a lot of banks focus on making sure that the front, middle, and back office are operating from the same playbook in terms of risk data. And cloud doesn't always immediately reduce costs. We see that over periods of years. It does give that agility fairly quickly, but the cost savings happen over time. And there are also some unique opportunities as well as challenges for firms in the capital markets arena. So on the opportunity side, of course, the potential for AI and machine learning. So combining those two top trends really around AI, machine learning, and cloud is a powerful combination. And we even see blockchain increasing the requirement for cloud infrastructure, whether it's a backup or adjacent services being offered to the cloud in addition to blockchain services. So there are other challenges as well, such as being a heavily regulated industry. There are proprietary data sets. We all know banks can't follow the Silicon Valley mantra of fail fast. So banks need to be much more conservative, but I think the level of conservatism is being thrown out a bit because of the the power of the cloud and also just the world that we now live in terms of being remote and also the ability to really on demand get these computational resources to solve specific issues within banks and across the trading and risk domain.
Well, and it sounds like, David, the efficiency and the cost savings that come out of using cloud have gotten most of Wall Street over any concerns they had about putting so much stake into Amazon, Google, or Microsoft. Yeah.
Yeah, I mean, you see a lot of banks just sort of deciding, well, which cloud are we going to go to, or multi-cloud? I think that they're over the hump of should we be in the cloud, right? I think there are clearly issues around certain cloud providers, certain jurisdictional issues that banks have to overcome. But I think the safety, the security issues. I mean, many banks will tell us that they view the public cloud as much more secure than their own internal infrastructure. It's just the way it is. Think of the amount of R&D, amount of eyeballs, the amount of engineers that are gone into securing these clouds environments it's just phenomenal.
Yeah.
To Kevin's point, I know the three of us have spoken quite a bit about this, but in terms of the risk realm, which is where we have quite a bit of crossover in our research, we've spoken a lot about how the demand case or the investment case basically for an investment in better quality data and via cloud delivery is certainly a bit more stringent than it is on the trading side. Essentially, there needs to be a significant cost savings under most circumstances, or a dire regulatory need to invest in this kind of infrastructure on the risk and regulatory realm that doesn't yield a direct profit oftentimes, most of the time. Where do you see the opportunities there for cost-effective migration that also produces a cost savings argument in terms of the tiers of firms, which we've discussed before, the differences among the tiers, but where are you seeing that sort of coincide with the trends in trading adoption for the cloud?
Yeah, we've talked about how that initial ROI it's a difficult hurdle to get over in particular for risk and certain elements of risk. And what we're seeing is, and we've talked about this, some of the tier 2, tier 3 banks now have an easier case to make to invest in some of these, putting more of their infrastructure in the risk domain into the cloud. There's certain end of day topics, there's certain regulatory drivers that are forcing people to think about these computational resources as solving a specific compliance need or risk need that needs to be solved over the next couple of months or quarters. So that helps with the ROI. It helps you get over that hurdle, is saying, look, we need to do this. This is a reporting issue. This is a risk issue. This is goes right up to the board, right up to the C-suite. So I think that ROI is getting a little bit easier, Danielle, in terms of the different banks, and particularly those tier 2, tier 3 banks that can see the potential cost savings and are just overwhelmed with the wave of regulations that have been coming over the last few years and increasingly going forward.
So with that, Danielle, I'm going to turn to you and segue into the next topic, which is communication and collaboration technologies and surveillance tools grow, which have been sort of big topics in the work from home dynamic change over the last 12 months. What do you have to say about that?
Just slightly increased in relevancy sometime around March.
Yeah.
So this 2020 was, of course, a bizarre year for so many things, but one of the areas, obviously, where we saw change, all of us saw change, no matter what industry you're in, is communication methods. But in the financial industry, it takes on an entirely different set of challenges and burdens, especially for compliance departments, but really for firms as a whole. So there's several areas in the regulatory realm that became immediately obvious as huge areas of concern when firms pretty much wholesale shifted to working from home environment. At the time, of course, I don't think any of us saw how long that was going to last, but what we did see, and to their ultimate credit, what I believe many compliance departments saw early on was that the amount of time that these conditions would be necessary is irrelevant. What is relevant is that we need to have the ability to do this, and we need to have the ability to provide employees secure access that they know how to access. So initial hurdles. There's cybersecurity concerns, and ultimately there's monitoring concerns, both satisfying direct regulatory requirements and protecting the firm in terms of satisfying common sense requirements. You can't be a financial firm of really any type and have an employee workforce that is forced to communicate both internally and externally on channels that are not able to be monitored. This seemed obvious, but on this scale, it was not something that every firm was prepared for by far. I think we put out research before where we estimate maybe only about 1/3 of firms were really prepared enough to sort of handle this shift without excessive fire drills. But many firms found themselves having to quickly figure out how to provide their employees those means of communication, and after that, how to monitor. The regulators have sent very clear signals. I believe, and most people who are looking at this right now in terms of technology are seeing this as well. Initially, of course, the goal was to support the effort to keep operations going, support the effort to keep employees able to communicate and do their jobs. And regulators in the US, Europe, and other global regulators were forgiving. The first no action warning came out, I think, March 17th, in terms of relaxing the written recording requirement. But the issue really is that at no point are the consequences of not being able to monitor these types of communications excused, should there be a breach for any reason. So that was a long setup to saying this really came front and center. We need to have communication channels that we can use internally and externally. We need to have the ability to monitor them, and not only just in recording, but in active surveillance, like we would have in terms of desk phone and regular hard business phones. So this, along with that, there's many parts of this, but in terms of global communication channels, we've seen WhatsApp a lot in the news. Firms are really at a point right now where they need to decide where to invest that active monitoring capability. So that's something that I feel remains to be seen right now, even though it's been prominent in terms of news flow, in terms of actions. It remains to be seen what makes sense for firms to be able to monitor and let their employees use for these purposes.
Great, big topic, and I think there's more to come on that in 2021. The fall of 2020 saw a lot happen in the equity exchange world, Shane. This one we title Equity Traders Demonstrate an Appetite for New Exchanges and Order Types. Want to talk us through that a bit?
Sure, and actually it does flow a little bit even from what Danielle's been saying. So we had 3 new equity exchanges launch in the US in Q3 of 2020, which is insane considering that was done completely remotely. So you know, in the history, we've never seen 3 exchanges launch within, literally days of each other in the equity space in the US. And of course, we've never seen that done when everybody was doing it remotely. MX literally built most of what they were running on from a remote position. So that is an incredible feat. And so you really can't overlook how amazing it is that they all launched. Some with more success than others. We won't belabor the point, but there certainly have been some issues with long-term stock exchange. Their technology was not as successful as some of the others, and there have been some concerns around how that impacts Reg NMS, how that, the requirements that even though there are no minimum ADV requirements to be protected when you are in the best bid and offer. You have a requirement to be able to go after them. So those will continue to be issues as we go forward. But MX and MyX Pearl Equity Exchange have both, garnered some market share, still trending under 1% of ADV. So, they haven't lit the world on fire, but they've actually garnered, reasonable amounts of volume in a relatively short period of time in an incredibly challenging market. So that's impressive to see. When you look at what else is going on in the, particular in the equity markets, off exchange trading has also kind of seen its inexorable rise continue. So last year, we breached 40% of ADV and off exchange trading, less than probably 20 times. And in 2021 and at the end part of 2020, we're seeing over 50% routinely.
Right.
That's a massive change. Is it worrisome? Is it bad? We haven't necessarily seen the market dynamics or the market metrics that would say this is a problem. I think everyone would agree at some point on the spectrum, if you see so much of the equity volumes go off exchange, it could have an impact to price discovery. That's kind of just almost mathematical, right? That there's some level where that would have an impact. I haven't seen anything that says that has happened today across the board. I think you can look at individual stocks, in particular less liquid names, that may see very large percentages of their daily volume off exchange. And the question often comes up is, why is so much volume going off exchange? What has shifted here? And there are some market trends which explain some of this, right? We've written about the retail expansion. The commissions for retail trading went to zero, right? We saw that move to zero, and then the market Borden hypothesis of, okay, everybody's at home without a whole lot of entertainment. All right, we can trade, and a huge explosion of retail volume now. Retail volume goes to market makers. A lot of that market maker internalization will drive off exchange volumes. There's also other order types. There's guaranteed market on close. There's conditional orders. There's block trading. A lot of the ATSs support these as well. So all of that order flow goes into off exchange trading. So again, we don't see it as a negative necessarily, but we do see it as something that everyone, market makers, the exchanges themselves, the regulators, market makers as well, everybody pays close attention to. So that is certainly, I think, the changes in the environment are such that you now look at, okay, what other ways of trading are there? And that's really where you see, the price time evolution in the markets have been, the mainstay, but that's where we look at what else is there. And that's, I think David had mentioned there are AI systems that are out there now. As I said, conditional order types have gained a tremendous amount of market share or of mind share. So there's a lot of growth in the non-traditional space too. And again, we'll just see how that goes forward as we move out.
Terrific. So let me transition a little bit. Let me transition from that a little bit. From you talk about the retail consumer and how they're driving change there. The next topic we actually have deals with that. It's called retail consumers continue to trade for free, driving more wealth management consolidation. We've seen a bit of that certainly in 2020. We know we've been involved in some things around that in 2021. Brad, where do we got going in 2021?
Yep, thanks, Dan. We all knew that zero commission trading would be a boon for retail traders in 2020, but I don't think anyone ever really expected this. Free trading in ETFs and the hottest equities of the day has led to an explosion in retail trading, which, when coupled with the market volatility we've seen in March and April, has placed even more emphasis and focus on the retail segment. And then at the end of 2020, we saw online brokerages begin to announce lowering their margin interest rates, which again is emphasizing the race to the bottom dynamic that we're seeing in retail wealth management. Looking ahead to 2021, we're expecting to see funds continue to seek efficiency gains, hoping to maximize their profitability by achieving economies of scale. And we've seen some activity there, such as Morgan Stanley's acquisition of Eaton Vance. And we will be keeping our eyes on new digital offerings that are allowing advisors to serve smaller clients efficiently while still providing higher value services to maybe some of their higher wealth clients.
Hey, Brad, you're our resident millennial. Do you think there's a generational shift in appetite for trading and risk taking, sort of just given all of the technological advancement?
Yeah, I think so. And I also think that, as people have been trading for the first time, maybe, the market has actually done pretty well since the initial COVID, reaction. And so people, could be pretty happy with the performance they've seen and, might not necessarily be thinking of risk in the right manner, just given their lack of experience.
Yeah, fair enough.
You bet. You bet. Let's run over to options. So options trading venues fight even harder to capture increasing demand. Shane, you want to talk about how demand has shifted in the options world and what might happen in 2021?
Sure. So it's interesting. Again, this is, I think a lot of these themes weave together. There's just been an explosion in option volumes. That explosion in volumes, of course, comes along with an explosion in message traffic. As Kevin mentioned, we've written on how well the markets performed during the crisis. We saw market peaks of insane levels of option traffic during the height of the crisis, and the market infrastructure maintained during that, which I think is an incredible testament to planning ahead of time. But we saw these huge spikes in individual stock option names. Again, a lot of that is driven by some of this retail trading as well. We see there are more than a dozen listed option exchanges, but within that, there are really only 4 groups that have control over all of those options exchanges. And I look back and we look at that, we saw all these new entrants on the equity space. We have some equity-only exchanges here. One thing that we are thinking may happen, if not in 2021, but going forward, would be some of these equity-only exchanges may want a piece of that option pie. That is not a simple technological task. Obviously, as I said, with the huge amount of options message traffic and some of the intricacies of the options marketplace, their price improvement mechanisms, their auctions, the interconnectivity required amongst all those exchanges, but it's not unsurmountable, in particular for the most sophisticated of the technology entrants. So if they decide to get into that, getting a medallion is a well-worn practice now. It's not the black magic that it used to be. How in the world do you start an exchange? Now, with time, effort, and money, you can start an exchange. And if you are an equity exchange, you can spin up a options market. So we think that's something that may be on the horizon, as well as there are other venues that are looking for ways to expand in the options space. So you see firms like the Dash ATS that are exploring how to be a ATS in the options world, which is a very different mechanism than you see in the equity space, where there is off-exchange trading. Obviously, those paired orders have to go to an exchange, but they have expanded a network. They are figuring out ways to bring it together. And there may be other ATSs in the options world that look to expand on a dark type of options trading. So with that retail expansion, you just see continued growth. We don't see that falling back. In particular, in a bull market, we don't see a whole lot of retrenchment there.
Great. Thanks, Shane. The next on the list, club and non-bank market makers grow in FX, settlement risk and credit intermediation in focus. Kevin, can we take a view on that?
Yeah, sure. So, I mean, talk about order books and non-bank market makers. Not new in FX. We've written quite a bit about sort of TCA and algo adoption over the last year or two. But I think what the market went through back in the spring of last year sort of really brought price discovery sort of back into focus. The role of liquidity from non-banks also sort of in focus as well. And really, as far as I can remember, since I've been at Greenwich, right, there's always been sort of an underpinning talk about improvements in sort of credit solutions for the FX market. It's so liquid, it's so big, but still, if you're not a bank, right, you need credit lines to come in and market make, right, and it's definitely held back some firms, I think, from doing more, from expanding their offerings over time, and there has definitely been some innovation there over the last year that definitely warrants watching. And then I guess the last bit that can't be ignored is sort of as uncleared margin rules continue to be implemented, there will be sort of more impetus to clear more instruments, right? So we've looked in our research too at the use of FX futures, for instance, rather than sort of their non-cleared alternatives. So there could be more of that as well. But FX is interesting in that it is very, electronic trading levels are high, often the highest of all the markets that we track. The market is gigantic. It is generally seen as liquid, especially amongst the major currencies. However, there are still some parts of the market structure that feel sort of very behind other markets that are as large and as well established. So it seems something that will be again in focus in 2021.
I noticed we don't have a bullet point calling out a trade reporting facility in FX similar to other markets that clearly show sort of market transaction.
Yeah. There had been some progress there. Some of the venues had gotten out and been able to report some aggregation, but the market is just so diverse, and the geopolitical issues that come along with, by definition, with a market of national currencies. I don't want to say it's impossible, because we've learned over the last 20 years nothing is particularly impossible, but it definitely will be like herding cats to create that level of transparency in the market. But never say never.
Right. Okay, next topic. Regulators and the market become more comfortable with tokenized assets, and we've been doing quite a bit in this space. David, do you want to talk to that?
Yes, what a transition from these trillion-dollar markets like FX to a market that is a tiny sliver of that, and coming off a base of almost zero. But I think in 2020 and coming into this year, a lot of people are seeing the growth of this broader digital asset ecosystem, and of course, with the rise of some of these cryptocurrencies, it's a headline in people's day, right? And then you take the next leap, right? And so many people are familiar with, Dan, with tokenized assets, right? So they're familiar with that. They know some of those are settling on a blockchain. But where the next leap is happening is now that these tokens are actually being linked back to actual securities that we know and love, right? In a regulated environment. So that's really the sea change here. And we've done through our research, we've really highlighted the benefits of tokenization, and what it allows for is to taking assets that are traditionally illiquid and digitizing them allows you to harness the benefits of blockchains. So we have that, the top benefit really is that immutable ledger of ownership and transaction history, like what we would have for traditional assets. So that immutable ledger is huge. The other advantages are smart contracts. So you allow kind of these securities to be programmable. And I've highlighted a lot of this in my blog, which I won't go into, and you certainly read about a couple of the most recent security tokens that have made a lot of the headlines. Those two are INX and Rcoin. One's an IPO, the other is a 40 Act fund. They're settling using Ethereum smart contracts. So there's a lot of really interesting things happening with those two tokenized assets in particular. But one thing that we found is that our research shows that there are really two things that stand in the way of these security tokens. And the reason we're bullish on 2021 is that these two roadblocks are being addressed. And first and foremost is that regulatory clarity piece. And on the regulatory clarity side, we're seeing SEC movement, we've seen the FCA license some exchanges, we've seen OCC rules come in to clarify what banks can custody. We've seen the SEC specifically with effectiveness for these tokens. So the regulators we won't say they green light anything, but they certainly are getting more comfortable with the market structure. They're getting more comfortable with the digitization of these private assets. And then on the liquidity side, secondary liquidity is often given the number two sort of drawback or limitation to security tokens, and that's being addressed as well. So we're seeing a number of technology companies come in, markets to really a broader value chain, really to support everything from issuance to custody to settlement, trading, registrars. We're seeing transfer agents. So we know that tokenized assets is a small market and will need liquidity, but you see movement there as well. So those two items, the clarity, the liquidity, there's movement there. And again, this doesn't compare to any of these other broader markets that we follow in terms of size, but we may be at an inflection point for 2021 to see more security tokens, more private assets that have historically not been made available to investors to be made available through the blockchain.
100%. Couldn't agree more. I think that's one to watch closely. And then number 11, not in priority order, but number 11 on our list is credit market electronification is redefined and becomes more diverse. Kevin, right up your alley. So let me give you a couple minutes on that.
Yeah, last but not least, for sure. And for those of you that know me, obviously one of my favorite topics. We've spent a lot of time, in particular over the last year, trying to understand how the market has evolved. We used to talk about electronic trading and phone-based trading. It's so much more than that now. On one hand, it's fantastic, right? It's given investors, market makers, banks, so many more tools to provide liquidity, to find liquidity, to understand pricing in the marketplace, to connect with buyers and sellers in different ways in different parts of the world. Obviously, all-to-all has grown, but that's really only the start of it. I can sort of call out. I mean, really, everybody has in 2020 released new protocols, markets. TradeWeb, MarketAxess, Bloomberg, Trumid, ICE. Everybody has sort of come out with something new, and it's really hard to compare apples to apples. Of course, we're going to continue down the path to try to do that and help you all understand how that all works. However, we said in the note about sort of redefining electronification, and I think that's it. We're going to see, not just the bond market, but less liquid assets, securitized, structured. Right? There's ways to take, as Danielle's points earlier. Right? There's ways to take well-monitored bilateral communication and put some structure around it. Is that electronic trading in the traditional sense? No, but it certainly is a new way of applying technology to help make markets more efficient. And let's not forget the fixed income market is huge. It's incredibly diverse. Product to product, country to country. There's a lot of a lot more room to grow, a lot more room to innovate. So it's interesting. We've gotten to the point where corporate bond markets, which were once seen as sort of slow and old, as now almost leading the pack in terms of innovation. In the fixed income market. So it's going to be about sort of redefining and rethinking about what electronification means and how technology is applied. And we're expecting growth, and hopefully we'll be able to figure out how to explain it and bucket it and let everybody see sort of where the real successes are coming from.
Great. Thanks, Kevin. Thanks to all you guys for your thoughts, ideas, and top trends for 2021. And thanks to everybody on the line for hanging with us. I know we've gone a couple minutes over what we usually target, but a lot to talk about, and I know we actually went through them fairly quickly. So if anybody wants to connect with us and discuss this further, we'll talk about it all day. So reach out to us. You have our contact details here at the end. Talk to us individually, talk to us as a group. Would love to engage. Again, if you have any questions, couple questions that come in, we will get back to you directly on. And if you have any others, like I say, please feel to reach out. Lastly, we do have a survey, as I mentioned before. Please take a minute. If you can fill that out, that would be great. And again, thanks everybody for attending. Be well, stay safe, and best of luck to everybody for 2021. Bye for now.
All right. Thanks, everyone.